Signing a loan sounds like the ultimate act of love and loyalty, but have you ever stopped to think about what it could quietly do to your financial life while you sleep? We're talking about a decision that millions of people make every year, often without realizing they've essentially handed someone else the keys to their credit score. Here's the thing, most people don't get told at the kitchen table when a family member slides that paperwork across to them when you cosign. You are not a backup plan. You are equally responsible for that debt from day one. The lender doesn't see you as a favor doer. They see you as a co-borrower. Full stop, no asterisk. The moment your signature hits that dotted line, that entire loan appears on your credit report, just as if you had taken it out yourself. Your debt-to-income ratio shifts. Your available credit tightens, and any future lender you approach will count that obligation against you like it's your own mortgage, car note, or student loan. Now, picture this. You co-signed for your cousin's car 2 years ago. Everything seemed fine. And then one Tuesday morning, you get a credit alert that a payment was missed, and suddenly your 750 score has taken a 30-point nosedive overnight. You didn't miss a payment, you didn't buy anything reckless, you were just loyal, and loyalty just cost you a refinance opportunity or a lower interest rate on your next home. The historical pattern here is almost darkly comedic because this story has been told 1,000 times across every generation. From parents co-signing for college apartments in the 1980s, to millennials doing it for each other's personal loans during the pandemic era. Each time, the person co-signing says the same thing. I trust them, they'll handle it, and the credit bureau does not care about trust, not even a little. There's also the psychological weight that nobody warns you about, which is the constant low-grade anxiety of knowing your financial fate is partially in someone else's hands. Behavioral economists would call this an involuntary shared risk transfer. But most of us just call it checking someone else's bank account and hoping for the best every single month. The misconception that really needs to be buried is the idea that co-signing just helps them qualify and won't really affect you unless something goes wrong. That's simply not how the system works. Every credit inquiry made when they applied already dinged you. Every reported balance is already sitting on your profile, and your own borrowing power has already shrunk, whether they pay on time or not. So what do smart, prepared people actually do when someone they love needs a cosigner? They run the numbers first. They look at what that added debt load does to their own debt-to-income ratio and ask themselves honestly whether they could afford to make those payments alone if the worst happened. That question, asked honestly before signing, has saved more credit scores than any credit repair service ever will. If you decide to move forward, protect yourself with documentation, a written private agreement outlining repayment expectations, and by monitoring that loan the same way you monitor your own accounts. Some lenders will even allow you to request a cosigner release after a certain period of on-time payments, and pursuing that option aggressively should be part of your exit strategy from day one. The broader lesson history keeps teaching us is that credit is a long game, and one emotional decision made in a moment of generosity can reshape that game for years. Discipline here doesn't mean being cold or refusing to help people you love. It means structuring your help in a way that doesn't put your own financial foundation at risk. There's something almost poetic about the irony that the most generous version of yourself can accidentally create the most financially vulnerable version of yourself. True generosity, especially when it comes to your credit, often means saying, I can't cosign, but here's what I can do instead. Whether that's helping them build their own credit, pointing them toward a credit union, or just being honest that your own financial position doesn't allow for it. The practical playbook is straightforward. Never cosign for an amount you couldn't stomach paying yourself. Always set up account alerts so you know immediately if a payment is missed, and treat the relationship openly enough that money conversations don't become landmines. Position size matters in investing, and risk exposure matters in cosigning. Keep both within limits you can actually manage without panic. At the end of the day, your credit score is your financial reputation, quietly working on your behalf even when you're not thinking about it. And protecting it is not selfish, it's strategic. Whether you co-sign or don't, whether the loan goes smoothly or sideways, what matters most is that you made the decision with clear eyes, a rational framework, and a plan for every outcome. And if you can walk into that conversation with your loved one with honesty, boundaries, and a contingency plan already sketched out, then you've already done more for your financial health than most people ever will. Preparation isn't pessimism. It's just what financially resilient people quietly practice while everyone else hopes for the best. If you're ready to take real steps toward protecting your credit, building wealth through real estate, finding trusted contractors, or connecting with the right lenders, we can help you get started. Check out our links in the description below.